Every 10 years, approximately, the U.S. endures a recession, and that has been the case going all the way back to World War II. So the question for us as we approach the 2030s is not will there be a recession, it's how bad will this recession be? And we do think it's bad enough to call it a depression because of how long this will last.
Welcome, everybody. This is Buck Jarvis with the Wealth Formula Podcast, coming to you from Montecito, California. Before we begin, a couple of reminders. There is a website associated with this podcast called wealthformula.com. Lots of resources there, including the Wealth Formula Investor Club. You can sign up for that. It's basically an accredited investor group. If you want to see some deal flow, you want to see some stuff that is not out there in the public eye, and potentially participate, make sure to sign up. Again, you go to wealthformula.com and sign up for Investor Club and get onboarded. The other thing to point out is that we are, again, taking new people into our Wealth Formula network, which is essentially a mastermind for the group. If you go to wealthformularoadmap.com, you'll see a free course there. A lot of familiar faces like Tom Wheelwright, Ken McElroy, Dean Graziosi, a bunch of folks like that. You can just download that for free. And if you are also inspired to do so, use that as the backdrop to join our mastermind group. And that is basically a monthly thing. Subscription, first month's on me. If you don't like it, don't do it. And check it out, wealthformularoadmap.com. Now let's talk about this week's show. You know, I've interviewed these guys over at ITR Economics a few times. They've been predicting this Great Depression beginning around 2030. And listen, they've held firm. We've had them on several times the past 7 years. I have multiple representatives from their show, and they say the same thing, unwavering from that forecast. Now, what's the big deal? You've got one macroeconomic firm saying that there is going to be a depression. You don't hear anybody else talking about it necessarily. So why should this be alarming? Well, they have predicted at an uncanny rate over the last 75 years. Their predictions have been 95% accurate. And this is the in-house prediction of the century for them that they have been, been really had high convictions about. Why are their convictions so strong? Well, that's what the interview today is going to be about. We have another representative from ITR Economics. And once you hear the reasoning, it'll make sense. The major drivers ultimately of this, as you will learn, are debt and demographics. We're spending unsustainably, and entitlement programs like Medicare and Medicaid, programs that virtually no politician has the appetite to reform, are going to essentially create this bad situation, are essentially going to create this situation where we have a tremendous amount of debt. At the same time, we've got baby boomers who will make up a huge chunk of the U.S. population, all out of the workforce in retirement, and they'll become a significant economic burden. So it's really putting two and two together. It seems inevitable, but as you listen, I just want to introduce one wild card idea to you that you can think about during this interview, and that is artificial intelligence. Okay. Now, I truly believe we're on the cusp of a technological transformation that really could rival the Industrial Revolution. Think back, you may have heard me talk before about Thomas Malthus, who predicted global famines due to population growth. Well, what he didn't take account for a few hundred years back is that there was the invention of the tractor, which revolutionized food production. And so that mathematics didn't work anymore because it was based on variables that were incomplete. In the same way, it is quite possible we may be underestimating the impact of the artificial intelligence world, the world of robotic technology. Right now, economic growth is tied closely to the size of a country's working population. Look at what happened to Japan. Basically, 3 decades of no growth because they've got a massively shrinking population. The same thing's probably going to happen in China because of their one-child policy that they had for decades. But But what if AI allows us to dramatically increase productivity with the same or even a smaller workforce? Just wondering what could happen. What if robotics drive a low-cost manufacturing renaissance in the U.S., making us competitive again without relying on cheap labor from overseas? Basically, you don't have to pay that much to a robot, right? In my view, these are the most important questions in American economics over the next decade. And to understand just how critical it is that we get this right. Again, this week's episode is going to lay out clearly what the alternative is in the next decade if we don't do something big. And it looks a lot like the 1930s. And we will have that interview when we come back. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Taylor St. Germaine. He's been on the show before, a senior economist at ITR Economics, which is one of the most respected forecasting firms in the world. If you're not familiar with ITR, they've been around since the 1940s, and they've built a track record of a 94% accuracy in predicting economic trends across multiple decades and market cycles. Taylor works directly with business leaders, investors, and executives across industries and helps them navigate the economy using ITR's unique methodology of leading indicators, rate of change analysis, and historical data cycles. He is one of the voices behind ITR's bold long-term predictions, including the potential for a 2030s depression, and has a clear-eyed view on what's happening right now and what's coming next. Welcome, Taylor. How are you doing?
I'm doing great. Thanks so much for having me.
Good. Well, let's start with this before we, start going out several years. We're kind of in really in an unusual time in economic history, which is funny because I think the last time you guys were on maybe was during COVID. It's just another unusual time in economic history. But with what's going on right now, I mean, first of all, how do you even make predictions? And second of all, I mean, presumably you still have some forecasts over the next 12 to 24 months, and maybe you could tell us a little bit about that.
Yeah, absolutely. Fun time to be an economist, to say the least. I joke with everyone. I say I roll over in the morning, and the first thing I do is hit the Wall Street Journal button. Is my phone. Right. I think we're dealing with today, but our methodology lends itself to times of uncertainty like this, and that's the benefit of really relying on the leading indicators that we have. Now, we do have to take a little bit of a different approach. We have to look at data in a lot higher frequency today. A lot of the data you get from government sources or quarterly data, monthly data, but we're having to track weekly trends with the ever-changing environment that we find ourselves in. So we're not surprised by the time any monthly or quarterly data comes out. The level of uncertainty that we're dealing with is certainly unprecedented. I share an index each day, and we are 3 times more uncertain today than we were at the height of the pandemic. Put that in perspective, right? Yeah. So we do have to adjust the way that we're looking at data with higher frequencies. We also have to rerun a lot of these correlation analysis every single time we get a new data point to see, are these lead times becoming more condensed? Do we have to make adjustments in our models as a result to maybe data reacting quicker than it might have in the past? So those are some of the ways that we're continuing to evolve in these interesting times we live in. This relates to our forecasts. Our team expected some weakness in the first part of this year, and we knew that coming in with the tariffs that were proposed during President Trump's campaign. We did have a weak first quarter GDP number forecasted. Our team was 0.1% off of nailing that first quarter GDP number, so they were right on the money there.
Were you higher or lower?
0.1% higher. 0.1% higher, yes. Okay. So we were very impressed with that, but we do expect a sluggish first half of the year. We call it the recovery phase of the cycle. In that, what we mean by that is our growth rates are still building momentum, but are still negative year over year. So we're getting less negative, but still not seeing most of the growth rates for the major economic indices we forecast popping positive until the second half of the year.
So do you guys anticipate negative GDP growth in the next quarter or a recession, official recession, or what's the
we think it's a very real possibility that we do see another negative quarter of GDP. Now, our baseline forecast coming into the year was that we had a slightly positive second quarter. The thing we're watching so closely, which is why we're thinking there could be some weakness, is because of that level of uncertainty. One forecast we did have to downgrade that weighs a lot on my mind as it relates to that second quarter GDP number is our CapEx forecast. Businesses are just hesitant to spend right now.
Yeah.
And so we did have to issue a downgrade to that forecast. And depending on how long this uncertainty extends, of course, the question is how many trade agreements does President Trump develop in the second quarter?
Well, to your point, like one thing I think is really, on the ground, just talking to friends who own businesses, that kind of thing. I was even talking to a friend of mine who's in manufacturing, who does not rely on China at all. And I was asking him, how's business? Must be great for you, right? And he's like, well, yes and no. I mean, kind of, but here's the problem, is that we don't know if this advantage is going to be there in a quarter. We don't know. So we're not ultimately doing anything differently than we would have. We're our baseline here, even in the best scenarios, to not go crazy with CapEx. So with everybody else who's trying to think about, like, okay, what these tariffs mean, and they do affect me, how do you possibly plan for anything? And if you're not planning for anything, effectively, that is almost sort of just like that is inherently going to slow down business growth, right? So it's almost impossible to get away from that. It's not even about the tariffs. It's about the anticipation or the lack of clarity that I would feel like is probably crushing us right now.
Uncertainty is the business killer. And I mean, we're seeing that more now than ever. You're right. Even if we came to the agreement of it's going to be 10% tariffs, it's going to be this way moving forward, and that's not going to change. Businesses adjust to that new reality, and then they make their decisions and move on. It's the constant back and forth changing of this that's really resulting in everyone sitting on their hands right now in terms of releasing some of this cash that's on the sidelines. So that's why I watch that uncertainty index closer than ever, because that can have a big make or break on that second quarter GDP being positive or negative.
So right now, again, just to be clear, you guys are thinking maybe slightly negative, right?
Coming into this week, we were saying slightly positive GDP number.
Uh-huh.
Because of the extension we've seen in that uncertainty index, our recession odds are moving. If you define recession by 2 quarters of GDP contraction, those odds are increasing. And we have to continue to watch how that data, really at the April data that's coming in this month, because as you know, the data lags a little bit behind. That's going to be very telling on, is that second quarter going to be decline or not?
Yeah. And it's hard to imagine that's just going to look good. So,
I will say the second quarter is the quarter we as forecasters worry the most about.
Yeah. ITR really known for its emphasis on leading indicators. So, when you guys, which of the leading indicators you guys rely on the most and I guess which are flashing red or green right now, and from your perspective?
I'll give you one of each. The fun we're in right now. We look at the Purchasing Managers Index, ISM's Purchasing Managers Index. Now, we look at it on a 112 basis. What I mean by that is we compare the most recent month to the same month 1 year ago. The reason we look at it on that basis is it gives us a 12-month lead time into the future when you correlate it to the economy. That index was recently rising until we got the most recent month of data, and then it dropped back down. Yeah. So that is giving us the mixed signal of, hey, we need to be a little bit more concerned about the prospect for growth moving forward. Now, the opposite is true when we look at an indicator called capacity utilization. What capacity utilization measures, it's about an 8-month lead time to the economy, so still a nice view into the future. But what it measures is output over capacity, and that actually continues to improve. Meaning, and again, really all that means on a simple level is we're utilizing more of our existing capacity, so we're getting busier as a result of that.
So how do people interpret? So how do you put that? I always like to kind of think about it with a local business. How should we think about that? Because, okay, so maybe you're not hiring a bunch of new people. Maybe you're not investing in a bunch of capex, but you are using what you've got more efficiently. Is that kind of what you're saying?
100%. Perfect way to sum it up. Yep. Mhm.
Got it.
Yeah, we might not be bringing on a lot of additional capacity, but for the existing capacity that we have, it's getting more and more use.
And that is, I mean, can you just, efficiency, can you just interpret that as, how much can you interpret that as something that's going to result in positive GDP? I mean, in some regards, I think about that and think, well, maybe they're more efficient because they're not investing, and that makes them inherently more efficient. But does that necessarily mean that it's a positive indicator for growth?
Now, anytime that capacity utilization rises, it has
Mhm.
been almost perfectly on the money in predicting economic upticks in it.
Okay.
We look at this data all, back 40 plus years.
Yeah.
It's those cycles right on the money. And the opposite's true, right? When that declines, we're in for some trouble. And it's been that reliable for us.
Yeah. Okay. Okay. So, ITR often talks about phase transitions in the business cycle. So maybe you can talk about what those are and where the U.S. economy in that cycle as of, right now.
Yeah, absolutely. Most of the manufacturing markets, I'll give you two answers here. Most of the manufacturing markets are either in that phase A, which is again recovery, which is the momentum's building, but we're not quite in the positive territory yet. Some markets have already transitioned to the phase B, though, which is accelerating growth, which is when those growth rates do pop above zero and there's more rise ahead. So we call it being on the front side of the business cycle. When we think of manufacturing, industrial output, those things are on the front side of the cycle, meaning businesses in that space, it's time to get ready for this growth, which I know is tough in all of this uncertainty.
Yeah.
When you look at these markets and leading indicators, there's a lot more industrial output that's coming our way. The consumer segments, on the other hand, are in what we call phase C, slowing growth, like retail sales is a perfect example of that. So we're still growing. Folks are still spending. We're just spending at a slower pace. The key takeaway from this all is you haven't heard me say phase D recession, which is the only other phase that's out there. There are essentially no primary macroeconomic benchmarks in the recession phase of the cycle. And that is not what we're expecting moving forward. The next time, to your point earlier, that we see recession characterizing the overall economy is not until 2030. So we will transition through these phases of the cycle, but mostly the growth phases of the cycle as we move into the balance of the second half of the decade.
So it seems to me what you're saying is, okay, so even if we have this technical recession, which, 2 consecutive quarters of negative GDP growth, maybe something that's just like, okay, it happened. It is, recessions normally do happen in cycles. We're just not used to them anymore because we went like 15 some years without it.
Right.
And, but after that, there is a lot of positive data. And so if the administration can sort of normalize things and get consumer, or not consumer, but business confidence back, there's a lot to be optimistic about. Is that fair?
You're exactly right. And I'll just remind everyone, the reasons GDP declined in the first quarter are not typical recession reasons for US GDP going through a downturn. You have to think about the two components that really drove the negativity. It was all of us trying to import ahead of tariffs, which when you calculate GDP is actually a mathematical detraction from GDP. And then the second part is government spending getting cut, which really never happens in this country, but thanks to Elon, Department of Government Efficiency, that created downside on GDP. So when you look at consumer spending, the big sectors of GDP, businesses, there's a lot of excitement in that GDP number, despite it being negative, because it's such an atypical driver of the negative decline.
Well, and I want to get back into that one comment you made about Doge and Elon. That I think a lot of people, including me, until recently, didn't realize how much of that GDP is driven by government spending. It's crazy, right? Like one of the things I know that Scott Bessent, the Treasury Secretary, was talking about how we needed to do this gradually because otherwise you would absolutely tank GDP, right? So, a negative in that regard, it's not all negative. I mean, it's not all bad
Right.
for the long.
Yeah, I mean, we need to get this spending under control. That's one of our drivers of 2030 being such a
Right.
problematic time. So it's encouraging to hear that folks are finally having this discussion and making some of that happen. But you're right. Think of GDP. 2/3 is consumer spending, all of us spending money. The remaining 1/3 of that is business investment and government spending. So it's not a small number.
Yeah. Let's talk a little bit about the Fed. Okay, the Fed seems to be sort of walking a tightrope. You know, how do you guys view this interplay between inflation, interest rates, monetary policy, and, you know, everything else that we've talked to up to this point? What's the inflation threat really right now? Or is that significant? How are you guys looking at all that?
Yeah. If we look at the consumer side of inflation that the Fed's more concerned about in terms of setting policy, we have inflation essentially flat this year from where we are today. Now, if you look at the CPI, it's at 2.8%. Our projection for the end of the year is 2.8%. We don't see inflation coming down much at all. And as a result of that, that's why you're seeing Chairman Powell back off being able to cut rates and is holding these rates steady because he sees these higher inflation risks as well. And so from our perspective, it's very unlikely you see any meaningful interest rate decline this year.
Yeah.
Now, again, the second quarter GDP number can have an impact on that. We do see a very weak second quarter. Chairman Powell alluded just a couple of days ago to some slack in the labor market. Maybe you can get a quarter point if we have a really weak second quarter point cut. But it just seems very unlikely given how persistent inflation has been. And so we tell all of our clients, prepare for interest rates to be relatively flat this year and prepare for interest rates to rise through the balance of the second half of the decade. It's not just tariffs. It's employment costs, it's electricity costs, it's material costs. There's a lot more driving higher inflation than just tariffs.
Energy costs are actually coming down too, though, right? I mean,
Yeah, you get a little bit of break in oil prices right now, which we all enjoy filling up our vehicles, of course. But our low point in our oil price forecast is this quarter. And then we expect oil prices to start to rise again as this demand picks up. So temporary relief in the energy market.
I would imagine like all that uncertainty on the interest rate side, though. I mean, how do you, again, make macroeconomic projections without, I mean, with that level of uncertainty, I mean, on interest rates?
Yeah.
Yeah.
Yeah. And, you have to look back at the fundamentals of the economy to see what's, I share with our clients, we expect interest rates to rise between 2026 all the way through the end of the decade.
Oh, you
And
do? Oh,
we
wow.
do. We expect interest rates to finish the end of the decade between 8 and 9%.
Holy cow.
Yeah, we'll talk more about that if we talk 23rd. But the reason for that is, again, all of these higher inflationary pressures building all throughout that time. Now, when I hear that, I went to our CEO, Brian, and I said, how in the world do we grow as an economy with interest rates rising like that? And he reminds me, you have to look at some of the fundamentals. People are making more money. Businesses have more cash and are more profitable than ever before. Some of these underlying fundamentals remain in place. For what it's worth, for some of the listeners that lived through the 70s and 80s, he also told me, you need a history lesson, my friend.
Yeah.
Because in the 70s and 80s, we faced far higher rates than this, and we still all invested in our businesses and bought homes and grew our wealth. But it is a new reality we're going to have to adjust to.
Do you anticipate that being a sort of a gradual rise, or, it seems, I mean, going from where we are right now all the way up to 8 and 9 when they're talking about, potential cuts. I mean, tricky.
We do expect it to be a gradual rise. I don't want to be too oversimplistic because some years inflation will be more relevant than others in terms of the pace that it grows. But yeah, you can basically say an increase in interest rates of about 1% each year through the end of the decade.
Wow. Okay. Okay. So let's talk about the famous predictions, right? The Great Depression of the 2030s. Are we still on track for that today? And one thing that I'm particularly interested in, as it relates to that, is the efforts of Doge and clearly a change in perspective, a real drive towards trying to cut costs. I mean, because I remember talking to, I've talked to a few of your folks over there at ITR, including you. And, that was a major driving force is just uncontrolled spending. So talk about why 2030 and, if that has changed at all based on what's happened or the perspective that we're seeing now.
Yeah, I want to if you allow me to just remind everyone of a
Yeah.
couple points around it. Every 10 years, approximately, the U.S. endures a recession, and that has been the case going all the way back to World War II. So the question for us as we approach the 2030s is not will there be a recession, it's how bad will this recession be? And we do think it's bad enough to call it a depression because of how long this will last. The five drivers of this are demographic trends, healthcare costs, social security cost, inflation, and national debt. Those are the five primary drivers that we highlight. The first, demographics, we are moving into unprecedented times, not just here in the US, but around the world, where the largest generation we've seen, the baby boomers, are leaving the workforce. And as they retire and move into those later years of their lives, that increases healthcare and social security costs, which are number 2 and 3 there. So that's a big drag on the government. And then you just heard me say higher inflation throughout the next 5 years means higher interest rates, which means the interest payment on our debt becomes a lot more problematic. Now, to your point around Doge in the Department of Government Efficiency, I went to our CEO and I said, look at what Elon's doing. This is great, right? What does this mean for 2030? And he laughed at me because he said, we are so far gone that saving $1 trillion is not even close to enough. Not to mention the primary driver of this is demographics. And you can't change demographics that quickly. If we all went and had a lot more kids, they're only 5 years old by 2030 and they're not paying taxes. So that doesn't change that situation for us.
Yeah.
Wanting to change 2030, you have to not only cut spending, but you have to increase taxes at the same time. That's because we're so far down this rabbit hole now. So the reality is what president in this country is going to get elected on raising taxes and cutting spending? Never going to happen. And that's why even with the Department of Government Efficiency's efforts, it's far too late and not enough to be able to change our mind about this.
Yeah, you talk a little bit about let's go a little deeper on that one because that's one that's probably everybody's like depression 2030.
Yeah.
Oh my gosh. What does it look like? Like 2030, when we talk about a depression, of course, we've been through recessions. We've been through even, a Great Recession. What does a depression look like? And, why is it so much worse than a recession? What does it look like?
The reason it's called a depression is because of the duration of time the decline lasts. So that's the difference between the depression and the recession. I'll make a comparison to 0809, the Great Recession, for an example. In 2008, 2009, the decline was immediate and straight down to the bottom, and then we rose out of it. The difference with the 2030s is we have a period of decline from 2030 to about 2032. Then we actually flatten off. And that's when everyone will get excited that, oh, this is over. And then we decline for another couple of years. So the difference is you're talking about a 2-year period of time in the Great Recession, which was just pain from start to finish. This is a longer term period of decline over 6 years. And it's not straight down. Think of the 1980s for those folks that lived through that, right? We declined, and then it looked like things were going to get better, but we declined even further. That's what the cycle looks like, at least from, mapping it out. But it is a 6-year period of decline. And the reason for it being 2030 to 2036, again, comes back to demographics. This is going to sound harsh to everyone out there, so bear with me.
You're waiting for the baby boomers to die, aren't you?
You nailed that. That's it. Everyone always says, why does 2036 the recovery? It's because based on average age, the baby boomers will be dead.
Oh, and then all the longevity medicine that's out there right now and the advances.
There's certainly risks to it. If the baby boomers live a lot longer than that 77 age, then we could be talking about longer. But again, the statistic that's important to think about is how much in 2018, 56% of all federal spending was just healthcare, social security, and interest payments on the debt. Just those three things were 56% of the budget. By 2030, the Congressional Budget Office projects that to jump to 70%. So you're talking about 70% of all of our federal spending being healthcare, social security, and interest payments on the debt alone.
So how does that translate? Okay, so just, I mean, it may be obvious to you, but I think sometimes it's helpful to just have a bridge for people who are not economists. So because you have so much spending, why does that translate to negative GDP? Like, why does that affect businesses directly?
Are you speaking more of the catalyst of why 2030 happens as a result
Well,
of?
I guess okay. I'm looking at like all these, these additional costs we have, right? And they get out of control. But then I'm thinking to myself, and again, and just, like as a business person,
Yeah.
okay, the government's got a problem here. Uh, why is it that I can't continue to do business as usual and be successful and that show and that be across the board and the government continue to and the economy still show positive GDP?
Think about the U.S. Treasuries as the guaranteed safe haven return they've always been.
Hmm.
If you want to say in the flight to safety, you go to the U.S. bond market, you go to the Treasuries, and there's always a guaranteed return there. Well, when these interest rates and inflation build and affording that interest payment on the debt becomes more problematic, what happens is the global economy loses confidence in the guaranteed return that the US has always been. And as investors pull back from the US, that ultimately is part of the trigger of why this downturn happens. That it ripples over to the stock market, of course. The bond yields and stock market are inversely related, right? And so that's the problem. And you already see the early warning signs of it building with China trying to get away from US treasuries and focusing more on things like gold, for example. Right. So it really does come down to a confidence thing. And as us economists like to say, a lot of recessions are self-imposed depending on our confidence levels as consumers and businesses.
Yeah.
And there's a lot to be concerned about that period of time with all of those concerns coming to fruition.
Yeah. I guess, and the other thing that you mentioned was higher interest rates. And if you have higher interest rates, it's harder for businesses to expand in that as well. Okay. So let's, demographics, you talked about demographics a little bit. I guess immigration could potentially solve that, but we're sort of shifting to, a anti-immigration kind of world right now.
Mhm.
So that's not something that you anticipate would be able to help with that situation.
The Germans are a great example of trying to offset this problem with immigration because they have a big baby boomer population as
Right.
well, and they see the issues. And so they're trying to incentivize young immigrants to come into their country, pay taxes, and to support the economy. That is obviously not our perspective here in the US.
Yeah. Yeah.
So could immigration lessen the impact if we took a different approach to it? But we have over 6 million job openings in this country, and we have about 1.17 legal immigrants coming into the country. Immigration is not offsetting this demographic and job problem that we have, not even close to enough.
Let's talk a little bit about sector specific stuff. Which okay, so first of all, for the next 3 to 5 years, and moving away from the depression, but I want to go back to the depression again right after this. But like, which areas do you think are best positioned, and which are sort of the most vulnerable, especially as we approach? No, I mean, we're only talking about 5 years,
Yeah.
5 years from now. So
Yeah. Again, we have record high GDP from the second half of 25 all the way through the end of 2029. So we're going to see very robust growth in this country.
oh, okay. So you're talking about a sudden, smack in the face at 2030.
Yes.
Okay.
Yes. And that's the playbook that we share with our individual clients when I'm doing some of my consulting work is, hey, you have 5 years of some amazing growth to prepare for this thing.
Mhm.
Don't invest in your business now. Enjoy 5 years of growth, but always be thinking with that 5-year horizon because we don't want to carry a lot of debt. We want to be cash rich as we go into the 2030s. But don't shy away from how exciting the second half of this decade really is going to be. So most markets we expect to expand. Now it's clear the US, if you even break down manufacturing, high-tech manufacturing, the communications, the semiconductor equipment, the electronics, a lot of the growth has been concentrated there versus legacy manufacturing, I'll call it. So there still is differences over the next 5 years of which markets will have better growth rates than others. But we really expect this overall economy to really grow and grow at a record pace for 5 years leading up to this.
Yeah. And then, okay, so then what about real estate? Because a lot of real estate, I mean, when you start talking about interest rates going up and stuff like that, and gradually, I mean, like it's one thing if you said, yeah, we're going to end up at, 8-9% in 2030, but before that, interest rates will be moderate. Like it's how does real estate get affected by this? Because it doesn't seem like it would be rocking and rolling for the next 3 or 4 years if interest rates are high.
The other side of that equation, though, is real estate loves inflation.
Yeah.
We saw that in the pandemic. And so that was one of the first things I said to our president and CEO was, well, with higher interest rates, how is the housing market going to survive? We have more personal and disposable income today than we've ever had before as consumers. So even though you see higher interest rates and inflation building, we've got more money in our pocket as Americans than we've ever had before, which allows us to continue to buy. Our perspective is that real estate property values, again, a little different commercial real estate, we can talk about that, but residential real estate, we expect some significant growth all the way into 2029 in overall property values. We tell everyone, get into a house and enjoy the equity gains of the next few years. But in 2030, the housing market gets pummeled.
So maybe you sell your house in 2029, find a nice rental, wait for the reckoning to happen. Okay, well, let's see. I've got my plan.
And what I'll say for the folks is the reason we say buy a real estate or a home in 2025, but not after, is because at the bottom of 2030, at that 35, 36 timeframe, we expect your home to be worth as much as it is in 2025. So that's the metric you can plan from. We don't want you to buy in 26 or 27 because you miss out on some of the equity gains and you actually lose at the bottom of 2030. But if you buy by the end of 25, we expect housing prices to be equivalent at the bottom of 2030 as they are today.
Yeah. So as long as you have an exit plan basically for before 2030, like in your business plan. So, we do a lot of, our listeners are involved a lot in multifamily residential real estate. So, I mean, I guess in this scenario, what you're saying is, well, those rents are going to go up because, people are going to have money and that's going to drive up rents. And, we still have a growing population. We still have a housing shortage. So those are the positive things about real estate over the next, at least the next 4 years.
You're exactly right. Yep, exactly right. Now, the caveat's always the government. You look at Washington and Seattle, they just put price caps on how much they can raise rents. That's just how, right? So there's always a caveat.
To buy in California, where I live, that's how I'd never buy it.
Maybe California and Seattle, you think twice, but overall, I absolutely agree with your comments.
Yeah. Let's talk just in general global dynamics right now.
Yeah.
China slowdown, wars in Europe, Middle East. How are these all factoring into your outlook as well? And again, how do you even start to factor that in? Because this is a great unknown.
Yeah. Anytime geopolitical events happen, like wars or conflicts, we always turn to the stock market and oil prices because those two things tell you how much the global economy cares about those things happening. I know it sounds awful to put it that way. That's just an economic lingo there, but you immediately can go to the oil markets and the stock market to see how concerned investors are about these events. And those metrics, oil prices and stock prices, have leading relationships to GDP. So we're able to filter those in correctly based on, the movement that we see in those two benchmarks. So those are the two areas I always tell everyone. If you're wondering how concerned the world is about these events, go to the oil markets, go to the stock market. They'll tell you how concerned they are. Now, we do expect this nationalism to continue to characterize our lives moving forward. Not, the U.S. first approach, China putting themselves first, these other countries really putting themselves before one another. And that does create a situation where more conflicts can arise, especially when you run into the demographic trends like we are. You look at China's population, they're in for massive population decline thanks to the one-child policy. Russia's going through some of that similar decline. There's a lot of folks that would say the reason uh, Putin invaded Ukraine is because the last time he had a young generation to be able to do that, right? And so some of those things do weigh on.
Fascinating.
I don't want to put my tinfoil hat on by any means, but when countries take this nationalistic approach and put themselves first, it does tend to breed some of these conflicts. But we as economists, again, we turn to the stock market and the energy markets to tell us how concerned we need to be as it relates to an overall economic standard.
Just out of curiosity, you mentioned China and the one child policy. I mean, I think it was for like 4 decades, something like that. I mean, a long time. And so it's basically wiped out a generation for the most part.
Mhm.
Are they going to be Japan? Like, because I remember when I was in high school in the 90s, I remember everybody thought Japan was like this incredible power and they're just dominating everything. And then they've been in a recession for like 20 years. And a lot of it is demographic pressure, right? I mean, they've just got very few young people. Is that same thing what we anticipate with China?
Yeah, similar. Yeah,
Huh.
absolutely. I mean, we've been telling our clients for the better part of 10 years, since we wrote the book on the Great Depression, we need to diversify ourselves away from China and we need to get out of there as quickly as possible because that people don't realize the repercussions economically of population decline like this.
Yeah.
And you're exactly right. Japan's a good test case for it. And China, you already see China's economy used to grow at double-digit rates back in, the previous 2 decades. Now they struggle to get into the low single digits. And a lot of the growth that they get is through taking on all this debt from the government investing in this growth.
Yeah.
So we're very concerned about China moving forward, and that has been a major point of emphasis for us and all of our clients is diversify yourself away from that region of the world.
So obviously you guys are not in the business of investment advice or whatever, but just in big picture, to me, it sounds like over the next 4 years, stay invested. First of all, I mean, for one thing, we do know the dollar with inflation is losing value, and so don't be scared. Make sure that you own things because if you own things, they are going to be protected. You'll be hedged against inflation. It does bring the question up, like, okay, so how do you potentially position yourself in, the late 2029 and all of a sudden you're all cash, but do you want to be in all cash? It's funny because, I would have never so 3 or 4 years ago, 5 years ago, when I first started talking to you guys, I would have never even brought up Bitcoin, but now since BlackRock owns it, it looks like some reserves are on the table. Some of the states have got, and it's just a matter of time, like gold, Bitcoin, these kinds of things. How do you guys look at them? Do you guys even take those seriously? Now, do you take Bitcoin seriously now as economists?
You might have heard our president and CEO of ITR just retired, and I asked them their thoughts on Bitcoin and the cryptos, and they said, we're too old for that. But I'll share with you, the way I think about it, and please know this is my personal opinion on it.
Oh, yeah, of course.
But, I see Bitcoin as a potential inflation hedge. About 5% of my personal investment portfolio is Bitcoin.
Yeah.
It's not enough to make up an overwhelming portion of it because I am always nervous about how the government's going to treat it. Now, I think we see President Trump's a little bit more favorable to it.
Yeah. Yeah.
But I need to remind everyone the U.S. government makes a penny on every dollar that's transacted. So in terms of Bitcoin replacing the dollar as a means of currency, if you think the U.S. government's going to lose out on that revenue, I just don't.
Yeah, I don't think that's what it is. I think
Yeah.
most of us who are, I've been involved with Bitcoin since 2017 now. I think most of us do think of this as a digital gold. And so a commodity like gold that will likely reach the same market capitalization or past gold for a younger generation. And so again, that's why I kind of bring it up in the context of hedges, right?
Yes. And I that's why I say it's part of my portfolio. It doesn't dominate it, but I don't want to miss out on this trend.
Oh, yeah.
If it goes, and I like the finite supply of it. It's similar to
Yeah.
gold, right? There's only so much that Bitcoin you can mine. There's only so much gold you can mine. And that's a lot different than our fiat currencies where we're always printing money and manipulating.
It's actually even more finite because there's only 21 million. We're almost there. So,
And I like that from not that I'm an Austrian economist, but I have seen classical economics leanings. And so I'm not ignoring Bitcoin. I'm not all in, but it's part of it.
Yeah. Cool. Well, single most important takeaway from our discussion today for retail investors.
Yes. Don't be afraid of the next 5 years. There's a lot to be excited about. If you need to take on some debt and to be able to grow over these next 5 years, do that, but make sure you have that 5-year horizon in mind and know that what got you through this decade is not what's going to bring you success during the 2030s. You are going to have to pivot your strategy business-wise and wealth-wise. So I don't want to scare you away from how great the next 5 years will be, but make sure you keep 2030 in your rearview mirror.
Right. Taylor, thank you so much for joining me and joining our podcast. As always, it's always really a fascinating conversation for me.
Thanks so much for having me again. I appreciate it.
Welcome back to the show, everyone. Hope you enjoyed it. I always find these ITR guys very intriguing. And again, they're so steadfast in this prediction. And it certainly makes you want to prepare for that, right? The caveat here is that you don't want to prepare too quickly because, again, if you listen to that interview, it seems like we've got a few very good years coming ahead of us. So, I guess if you want to start planning for 2030, you can maybe stop buying a lot of long-term type of stuff in the next year, 2 years or whatever. But the reality is, I think it's still a wild card. I mean, we don't know what's going to happen. AI is going to change a lot. Robotics is going to change a lot. But I think it does put into perspective, again, the need for cuts, the need for things like DOGE, the need for things like reforms to entitlements, which no one wants to do. Anyway, that is it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.